timing is more difficult than price projection. My projection by year end is between $2,250 and about $3,200. And that was based upon doing what's called a Fibonacci extension, which is basically putting retracement on its head. And that is my forecast for 2024. So I am exceedingly bullish.
On Thursday, the U.S. Labor Department released the Automatic Data Processing, ADP, employment change data for December and weekly jobless claims for the week ending December 29th. The data revealed a broad improvement in U.S. labor market conditions, with weekly jobless claims coming in at 202,000, down from the previous week's revised estimate of 220,000 claims and expectations of 216,000 claims. The gold market sold off somewhat in response to the latest employment data, with spot gold falling from $2,045 just before the report was released to fresh session lows of $2,039 immediately afterward. Though gold prices recovered briefly to begin the day, climbing back above $2,046 only to promptly fall back to the $2,038 range. The increased volatility in gold prices is no doubt tied to the unexpected strengthening of the U.S. economy. Since December's Federal Open Market Committee meeting, the market had priced in several rate cuts this year. However, these expectations are looking less positive with the jobless claims and unexpected employment data. Market participants have turned cautious about near-term demand for bullions as prospects in favor of rate cuts by the Federal Reserve are gradually unwinding. Regardless of these unfavorable metrics, which could further bring down gold prices in the short term, veteran commodity analyst Gary Wagner says he is exceedingly bullish on gold in 2024. Gary predicts that by year's end, gold prices will make new all-time highs and could even rise above $3,000 per ounce. Gary gives several reasons for his exceedingly bullish predictions for the yellow metal. According to the analyst, despite some indications to the contrary, there are still a lot of reasons to believe that the Fed will ease up on tightening, cut rates, and begin quantitative easing. Gary adds that all of these, alongside heightening geopolitical tensions in Ukraine and the Middle East, will be great for gold prices in 2024, 2025, and 2026. We will now bring you clips from Gary Wagner's recent interview with Kitco News. Ensure you stick around to the end of the video as the veteran analyst shares some important and bullish technicals for gold and silver prices. Share and like this video, and don't forget to drop your comments and observations below. Thanks, and enjoy the video.
Well, this is a daily candlestick chart of gold, and what I have plotted basically is a Fibonacci retracement. And the reason for doing that is as this market hit this high, and of course, this is back at the beginning of December 4th on a Monday, it came down with a pretty strong correction to approximately 1985, and then began to cycle higher, moving as high as about, well over 2000. But once the new year started, we saw some weakness in the market. Today is a strong day down. And so what these dashed lines here represent different Fibonacci important levels to watch. This one here, which is where the current pricing is at, 2049, is based on a 38.6% retracement. Typically, when you look at Fibonacci, what we're looking at is, first of all, his sequence, which is a very easy formula. You start with 0 and 1, you add them, you get 1. Then you go 1 plus 1 equals 2, 2 plus 1 equals 3, and so forth. And all of our viewers are familiar with that when they think about a nautilus shell, the way it revolves. And the reason that is such an important technique is that the relationship between each of those numbers is 0.618% or 1.618%. To give you a visual illustration, it's a blueprint of nature. So when you look at my hand, for example, this digit right here compared to this digit is compressed by 0.618, 0.618. So it's nature's way of growth, so to speak. And the financial markets picked it up years ago and found some real relevancy in it. So we're looking at where could gold drop to. because my sense is this will be a short-term correction, not that deep, and it will return to a bullish demeanor. So if it breaks through this level at 2048, the next level I would look at is 50%, which is not a fib number, but used. That's at 2018, and a deep retracement would come down to about 1987. And I'm not expecting it to go that deep. But that, in essence, is how we use Fibonacci retracements. Gold is very sensitive to interest rates. Interest rates moving up create a bearish undertone for it. Interest rates going down is bullish for gold. And the reason for that is gold doesn't yield any interest on it, so it becomes more of a favorable asset to hold during times of low fixed income returns. That is going to be a process that it happens over 3 years, because the Federal Reserve itself projected 24, 25, and 26 and how they're going to bring that down and bring down inflation, because, of course, their ultimate target is to get inflation to a 2% level. So that's exceedingly important, and that will be a multi-year process.
In addition to his expectations of monetary policy easing by the Fed, Gary is also bullish because of the increasing geopolitical tensions around the world, predominantly in Ukraine and the Middle East, where the risks of a greater conflagration of the Israel-Hamas war continue to grow. Houthi attacks on ships in the Red Sea continue to spur grave concerns about escalation. On Sunday, the United States military said its helicopters had killed fighters who fired on them when they came to the aid of a container ship. The US and UK are reportedly considering attacking bases in Yemen. Further escalation of the crisis means millions of investors will be rushing towards safe haven assets like gold and silver in 2024 and beyond. Let's get back to the interview.
One of the key differences between gold and silver, when I started in the industry, silver was the little sister of gold, so to speak, and they both tended to move in tandem. They both were sensitive to inflation. They were both sensitive to geopolitical risk. They were both sensitive to risk on or risk off, how the equities markets were doing. However, we saw silver go to an all-time record high at about $50 the first time gold hit above 1900, middle of 2011. And then on the subsequent new price highs in gold, silver kind of fizzled out. It found a trading range that finds resistance at around $30. And so when you asked, do I think it's going to double? Futures right now are trading at $23.20. That would be about $43. I would like to believe yes. Historically speaking and looking at the technical data, silver has been unable to do that. Now, something has to kind of give. Many people talk about that there's a scarcity in silver. I'm not privileged to that data, but if that's the case, that would be highly supportive of it. I am looking for silver to move higher by the end of the year, but it first needs to take out $26 per ounce. Here again is a daily candlestick chart of silver. You have this high that came in December 4th, the same with gold when we saw that reach an apex or a short-term apex. And from there, it has come down 61% and then began to move up. Now I'm using a data set that starts at these lows, and these lows occur in October. I call this the October rally. There was a geopolitical event, of course, that kind of sparked that, but that took gold substantially higher. It took silver from about $20.80 up to 26. When you look at the percentage gain in that, it's quite a lot. But from there, it retraced. And if you notice, there's a line here at 61.8%. That is where silver found support. It then found resistance at just below the 23.6%, which occurs at $25. Now it's moving down. So I want to see if silver continues down. Will it find support here? If it does, we will look for some sort of a candlestick pattern, such as this pattern here, which is basically a variation off a three-river morning star. And I'd like to see if we get that bounce, because as a technical trader, we're not aware of a pivot or a key reversal till it's actually already occurred. In other words, you see that V in the market. I'm trying to pick a market price point that it will find support as it's moving lower, to me, is trying to catch a hot knife through the air. You simply don't have the information. You need to see that pivot first. And a pivot can fail. You can see a key reversal, and that, of course, fails. But that's what we look for. So in terms of silver, it has been under pressure. It's currently trading down and at 23.20. I want to, 23.20. I want to look at it at about 22.90 for potential support. If it breaks that, it would be 2200. On the upside, resistance is 25, and above that, 26.
The likelihood of further decline in gold and silver prices, especially in the short term, is high. However, even if they come, they will be short-lived because there are many more reasons for increasing gold and silver prices. Factors like quantitative easing, a weaker dollar, global monetary system collapse, and others do not just support increasing gold and silver prices, they do so over the very long term. Please share your thoughts on Gary's predictions for gold and silver prices in the comments section below. Subscribe to the channel and turn on post notifications for more videos like this. You can also check out our other videos on gold, silver, and other metals and commodities. Thanks for watching.